Hi, for libertyandeconomics.com and the Liberty and Economics Review, I'm Nick Sorrentino. Um, much is being, today we're talking about, today is the 25th of February. Um, the Dow is down over 150 points at last look. And that's largely a reflection of the fact that actually 172.69 right now, 1.66%. Um, this is largely a reflection of the fact that the jobs number was worse than expected. It was expected to get a little bit better. It's actually a good bit worse. Housing numbers here recently came out not particularly good. Um, Greece continues to hang out there. There are all sorts of um, there's lots of uncertainty out there, and the market, as they say, hates uncertainty. And so you're starting to hear people, mainstream people, talking about a double dip recession. Well, um, I think that's kind of funny because aside from the people at Goldman Sachs and J.P. Morgan, um, with some exceptions, of course, I, there doesn't seem to have been a real ramp up in the economy since our big dip, the initial crash in fall of '08. It seems to me that we've been just kind of bumping along here, and the fiscal stimulus that was poured into the world economy by governments and central banks around the world, essentially papered over with paper money, a lot of the cracks that were out there, um, in the short term. But fundamentally, it really didn't change anything. The issues are still out there. That there's this big giant derivative hole um, is still hanging out there with the earth in its grip. Um, yeah, that hasn't gone away. I mean, you can print money and print money and print money, but eventually the piper's going to have to be paid, and we're just staving off the inevitable. I believe. I mean, maybe I'm wrong. Um, for most people, most middle class people anyway, I think that I don't think a lot of people would say that the recession has been easing for them. Um, small businesses can't get credit, which may or may not be a good thing, really. But they certainly can't expand. It's tough. They can't hire people, which in turn slows the economy, of course, and all that. But the big banks that have access to the Fed window, and they can get their money from the Fed at 0% interest, and then you know either hold on to it if they want to, which they're doing, or loan it out at higher interest rates. I mean, it's nice to get money at zero and then loan it out even at a low interest rate of 4.5%, let's say. Um, when nobody else is making anything, um, you're essentially making money with no risk. That's a good deal. And that brings me to Goldman Sachs in Greece. So I read about a week and a half ago that the guy in charge of the Greece bailout was a Goldman Sachs guy, and I just thought that was amazing. And it just seemed par for the course. But now word is the Fed is looking into Goldman Sachs and seeing whether or not the big banks are actually betting on a Greek default. So the people who essentially set up the debt structure that Greece operates under, I mean, more or less. I mean, through there are lots of big banks, but essentially they kind of all work together. So the people who built Greece up with all this uh, baloney, um, economic baloney. Their economy is based on economic baloney here. Maybe there's some Greek equivalent of baloney I don't know about. But anyway, now that it's falling apart, they're betting on that. They're betting with in the derivatives market that potentially. Uh, some people are thinking that some of these large banks are actually betting that Greek will now default um, on their sovereign debt. As I mean, that's nothing new, but that's great to know that Goldman Sachs and J.P. Morgan, those guys are out there playing both sides of the deal. Um, I mean, it it's par for the course. I mean, that's the world we live in now. Fiat currency. The central banks are in tight with the government. The big banks, the quote unquote private banks, are tied in with the government and central banks, and it's just a huge fiasco. And anyway, so interestingly, former Fed Governor Heller is coming out and saying, "Look, a quote unquote double dip recession is going to happen, and that the Fed is going to have to raise interest rates here in the short term, which is going to just hammer the economy that much more." Uh, this is bad news, guys. This is not good. Have we taken our medicine in 2008 and just really hammered in the short term? We'd be coming out of this by now. But now, because essentially the Fed has, um, gone in and bought assets and created all this cheap money and just flooded the world markets with this stuff. Um, Now we're really going to pay. I mean, I think there's real potential here that this next dip, although I don't see it as a dip, I just see it as another leg down, kind of like this, here, there, like that, um, could be extremely nasty, potentially nastier than what we saw in fall of 2008. Um, I pray that I'm wrong, uh, but we'll see. I just want to leave you with this fact. One thing I think it was one of Obama's economic guys out there. He was like, oh, there are no soup lines. That's what we could have had and all this stuff if we hadn't done what we did. The thing that's interesting is that the soup lines are now virtual soup lines. We have soup lines. It's just that um, people are given these. I guess they're called EBT cards that are loaded up with money for food and so on at the beginning of each month. Um, and the thing that I found this amazing was that 1 out of 8 adults in this country is on food stamps or using these EBT cards, and 1 out of 4 children is. That's not good. We need to get our house in order and start dealing with economic reality instead of economic fantasy. I don't care how many degrees Mr. Bernanke has and how long he taught at Princeton. Um, I mean, we're headed for uh, you know. Let's just hope that it gets better. Anyway, till next time.